Are you surprised that interest rates, I mean, they didn't do anything on the taper announcement, but I guess the bond market's job is to anticipate such things, is it not?
Yeah, that's exactly right, Brian. Thanks for having me on the program again. I think ultimately investors knew that this announcement was coming. I mean, the Fed has done an extraordinary job of communicating clearly to the market that this is what should be expected as the economy had made substantial further progress towards the Fed's goals. The real question going forward is, could they speed up the tapering process? And I think Chair Powell really raised a high bar for that. We expect the process to last, as the Fed does, into the middle of next year, at which point the Fed will have more information with which to make a decision about what comes next.
And what do you think does come next? They gave themselves the out on the taper. They could actually reverse their decision to taper off. They could change that in January. But everybody's more thinking now about rate hikes, actual hikes in interest rates by the Fed. Got estimates on the street from anywhere from July of next year to out to 2024, I think. Where do you stand?
Well, Brian, our economists have the Fed raising rates in early 2023. I think at this point, that is broadly consistent with the dot plot that we received in September. I do think that there are still, though, questions about how the economy evolves next year. And the Fed, for its part, made it clear that it's still very uncertain, and it really wants to see the next 6 months or so of data to get a better read, Brian, and to have more certainty about the outlook in a world where we're not dealing constantly with these waves of COVID-19. That's really what the Fed wants to see, is a more normal world, and then assess what's the next appropriate step. I would flag, though, Brian, for your listeners, that it's not guaranteed that what comes next are rate hikes. It's possible that the Fed decides that in this cycle, normalizing the balance sheet should have higher priority than lifting rates off of the zero lower bound. That is going to be an interesting discussion to monitor over the next several months.
Yeah, because if we get some of these spending bills done, we're going to add greatly to national debt. I mean, some people have argued, Matthew, we're not wading into politics, don't worry, but as we add to the debt, it almost becomes mathematically impossible to have interest rates go above a certain level.
Well, Brian, I think ultimately the biggest driver of interest rates in the United States is Federal Reserve policy. And if they do begin to reduce the size of their balance sheet, it would almost certainly occur gradually, but that would put some upward pressure on interest rates. And furthermore, if the Fed were then to decide to start raising interest rates in the short end of the yield curve, that would also put upward pressure on interest rates even further out the yield curve. So, Brian, ultimately, interest rates should go higher if the Fed does want to begin the process of tightening policy next year.